Good morning, everyone, and welcome to Wellington's Q3 2016 results conference call. I'm Howard Milner, Wellington's CFO. Last week we announced to the market our Q3 result and updated guidance for the 2016 full year. I will make some additional comments on the financial performance, and then Greg Allen will provide an update on progress for our new products in the market. I must start with the usual warning. We'll be making forward-looking statements on the call today. As these are predictive in nature, they are subject to a number of risks and uncertainties relating to Wellington, its operations, the markets at which it competes, and any other factors, some of which are beyond our control. Actual results and conditions may differ materially from those expressed or implied, although we sincerely hope not. The result for Q3 was an EBITDA loss of 427,000 Kiwi on revenue of 6.3 million. This is an improvement on Q3 2015, which was an EBITDA loss of 607,000 on revenue of 5.1. It is a loss which I think was well signalled and is due to Q3 being our seasonal low point due to Northern Hemisphere summer holidays. It does represent the sixth quarter in a row of US dollar revenue growth, and we see no reason why this will not continue for many more quarters. On a year-to-date basis, that is for the 9 months to the end of September, revenue in New Zealand dollar terms is up 34% compared to 2015. Gross margin is up 1.7% to 23.6%, and our EBITDA loss has reduced to 149,000 from 1.3 million in 2015. Some of the features of the year-to-date result are the number of motors sold increased 21% to 983,000 units, including 62,000 new ECR2 motors. 37,000 SCS Connect controllers were shipped to customers. US dollar revenue increased 27% to 13.4 million. All regions experienced growth. New Zealand dollar revenue increased 34%, reflecting legacy motor volume increases, SCS Connect and ECR2 sales starting, and a lower average US dollar New Zealand dollar exchange rate, 68 cents for the 9 months compared with 71 cents for the previous year. Gross margin improved to 23.6% with our supplier-based cost reduction continuing to deliver results, mostly as a result of volume increases. Cash was 2 million, although this included a 1 million drawdown of the Superlife debt facility. In terms of how Q4 is looking, we said in the announcement that it is looking stronger and close to revenue levels earlier in the year. You may recall that we reported revenue in Q1 of 9.2 million New Zealand dollars and 9.5 million in Q2. And there are indications that we may do better than this in Q4. Customers can and do reschedule orders in and out of Q4, but we think it unlikely that Q4 will not be in line with our guidance. We look forward to reporting a profitable, at EBITDA level, Q4 result in due course. We continue to manage cash very tightly. The Superlife facility was needed to manage the working capital demands that come from growth. We are in discussions with trading banks and anticipate that the company will secure a bank facility sometime in 2017. At this point, I'll hand the call over to Greg to update you further on our new motor and controller products and to comment on how 2017 is looking for us.
Thanks, Howard. Hi, everyone. I'm coming to you from Toronto, Canada today. I'm actually on the road visiting two of our largest ECR2 motor customers. Tomorrow I'm heading off to St. Louis, Missouri, home of Budweiser. A guy called Carl Conrad back in 1876 brewed the first bottle. If there's any Budweiser drinkers amongst you, that's where I'm heading off to tomorrow. So anyway, on to our results. It's good to be able to talk to you today, and as we head into what's looking like a very busy fourth quarter, and one that we hope we will be able to secure our first full year of EBITDA profit. We're fairly satisfied with our year-to-date performance, especially all key indicators showing improvement on last year. The loss for Q3 was certainly a challenge, but it was one we expected and signalled. We think the growth in our new ECR2 motor and SCS Connect product will help to alleviate the impact of this kind of seasonal downturn Q3 next year. Our gross margins continue to improve, and in Q3 we achieved our long-stated objective of 25% in the quarter gross margin. We are still working hard with our supply chain partners to find further cost reductions on motors, although the low-hanging fruit in terms of cost reduction has now been picked. We expect volume increases to provide some further reductions over time. We're anticipating stronger revenues in Q4 and are confident that the company will achieve its full-year guidance of significantly higher revenues than those recorded last year. And as I said before, we are now signalling the possibility of a modest EBITDA profit this year. I would not say that is certain yet, given how our customers tend to move demand around between year-end and Q1, but the probability of this result is increasing. We are very pleased with the progress we have made to win business with our new SCS controller and ECR2 motor. The SCS business with a major retail brand that we announced at the end of last year and has been shipping this year is expected to further expand into 2017 as we bring more of that retail brand's network online with SCS. The relationship has also expanded to include ECR2 motor business. There is still much work to do to convert new brands and manufacturing customers for both of our new products, but we're making great progress in setting up continued growth for 2017. Our focus for the next 12 months with SCS Connect is the carbonated soft drink, or CSD market. So our customer focus is also on this sector. Honestly, we have many opportunities presenting themselves outside of that core market focus, but we've decided to stay very focused on our strongest markets first with our new products and not be as opportunistic in new market areas. Focus, 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 focus is our growth mantra going forward in the CSD space. This market is also driving the need to continue to evolve the SCS hardware and software to ensure we are keeping up with changing customer needs, particularly as communication technologies evolve quickly and software tools and services develop. This customer-driven evolution of our existing SCS product will drive some modest investment in software and electronics engineering next year. Our guidance for next year was that we expected to double SCS Connect volumes and that we are targeting a 20 to 30% annual revenue growth overall. And early customer demand indications for 2017 are that we will achieve this target and possibly even do better. We're currently involved in some large global negotiations for the sale of our new ECR2 motor and other motor products, and those negotiations are moving along well. They are still in progress and not complete, so I would expect we could update you all and the markets further, say late Q4, early Q1, once we have confirmation of these projects. As part of these negotiations, our customers are looking for us to continue to innovate in the EC motor space and help them with a broader range of cooling solutions. We're exploring 2 new products here with customers as part of these global negotiations. One is a derivative of our ECR2 platform, so not really a new product, just an iteration on the existing one for higher power, larger cooler applications, and one is more focused on high volume, lower cost cooling solutions. These would be products we would start developing sometime in 2017 that would be available to bring to market in 2018. We think it's really important we don't stop the innovation engine at ECR2 and SCS, and we continue to use those 2 successful platforms to continue to innovate for customers. Otherwise, we will fall behind our competition. Next year is looking really exciting for us with anticipated demand increases for our new products, continued revenue growth, and continued margin expansion. I mentioned in the written market update that the team is focused on putting in place additional supply chain capacity and customer field support to meet our requirements next year. So what does this mean? We're bringing on our supplier partner East West as a second source for our SCS Connect product, effectively doubling capacity for this solution for 2017. And we're also hiring field engineers in Latin America and Europe to support training and field technical support as our SCS solution rolls out to brands and bottlers. Our 2017 guidance of 20 to 30% top-line growth and EBITDA profit in the low millions remains in place, but I would say that I'd expect to update our 2017 guidance over the coming months as demand for that new season is known. So thank you everyone for listening, and I'll hand it to the operator for Q&A.
Thank you. Ladies and gentlemen, if you would like to ask a question, please press star 1 on your telephone keypad. Please ensure that the mute function on your telephone is switched off to allow your signal to reach our equipment. Once again, please press star 1 to ask a question. We will pause for just a moment to allow everyone to signal. Thank you. And we have our first question from Blair Tallot with ACC.
Hi, Blair.
Hi. Hey, could you just cover a little bit more about that, your production levels and where you're taking east-west? I didn't quite get the understanding of that, what you were talking about there.
Okay, Blair. Currently, we have a manufacturer for our SCS in Malaysia. It's our electronics manufacturer, a company by the name of MEI. So they've been producing SCS for us all this year, doing a really good job. Our supply chain strategy typically is to have two suppliers for our strategic products. So we manage risk. If one supplier has a problem, another one can come in and follow on behind, and also to give us a ton of flexibility as suppliers increase their volume needs. So we've got an existing supplier in Malaysia. It's a long-time supplier of ours. They've been delivering all this year, and we're bringing on East-West as a second source for SCS, doubling our capacity because we think we'll need it next year on SCS, and also giving us that risk mitigation, right? If one supplier has a hiccup, the other one can come in and make sure that we don't let customers down.
Okay, so that's quite easily done by the sounds of it, yeah.
It takes, look, we started bringing East-West online with SCS 3 months ago, so they'll be up and ready to run probably January, February, so it normally takes 6 months, maybe a little bit more. You know, we take our time to make sure they've got the quality right, so yeah, this will be about a 6-month bring-up project for SCS and East-West.
Okay, no, that's good. Thanks.
Thank
no problem,
you.
Man.
We take our next question from Roger Armstrong.
Hey, Roger.
Hi, Greg. Hi. Can you give us an update on what's happening with all your various field trials for the SCS? Are you adding more places, more customers, or are you furthering the status of any trials? Is the momentum occurring in that area?
The way I describe the field trials now, Roger, is they're getting quite mature, and we're not. The last one we added was in Africa, actually, but that was still 6 months ago. We haven't really added any brand new ones. All the market for our brand customers is fairly saturated with field trials now, and I would say those field trials are moving towards more of a decision point. You know, do we now say the field trial has passed and moving into more of a production state, which is, I think, where we are with all of them over the next, let's say, 3 months or so. We're going to, I think, have some of those field trials switch into production mode.
Right. Okay. Thank you very much.
Thank you.
No problem.
And ladies and gentlemen, as a reminder to ask a question, please press star 1 on your telephone keypad. All right, it seems we have no further questions at this time. Oh yeah, we have one from Grant Taylor.
Oh, hello, Grant. Thank you.
Gregory. Hey, just one question, just with regards to you talking about SCS and doubling of the production capability. Are you able to give us any guidance on what your incumbent in Malaysia was capable of producing, and/or what you're seeking to get out of your new supply partner with regards to production capacity in SCS?
I can actually give you some guidance on that. I would say now so I'll give you some rough capacity numbers. This has obviously got a lot of headroom in it, so I wouldn't say this is what we expect to deliver, because you always need 20-30% of flex in a capacity envelope to manage for lead time flexibility. But our current supplier in Malaysia was able to do, let's say, 200 to 250,000 a year run rate. That's steady state. Sometimes you do more in 1 month, Grant, and less in another month. But at a steady state. So when East-West is fully up and running, we think we'll have a capacity envelope at around about 500,000 SCSs a year. That answer your question?
Yep, Sure, that answers it.
That's not what we're expecting to deliver to revenue necessarily, but it's certainly what we need to be able to manage all the lumps and bumps, and obviously that would tell you, that's the reason why we're talking about growth next year and about profit next year. We're putting in that capacity in place because we're pretty confident we're going to be able to consume a big chunk of that.
Thank you.
Thank you. And we have no further questions at this time. Ladies and gentlemen, there's star 1 to ask a question.
Okay. No more questions?
No more questions now.
Finish off. So thanks everyone for listening. It's not every day. In fact, I don't think I've ever, in my 5 years at the company, been able to, 2 months out from the year end, tune guidance to indicate the possibility of an EBITDA profit, albeit, with some still a little bit of risk around it. But I'm quite pleased that I'll be able to talk about that, and certainly, you've heard me talk positively about the growth of our 2 new products next year. So, looking forward to a really good Q4 and a strong start to next year, and updating you in the new year on fourth quarter and how the year went. So thanks for joining.
Thank you, ladies and gentlemen. That will conclude today's conference call. Thank you for your participation. You may now disconnect.